Welcome to the Probate Nation. You know, probate is very much like a trip on a slow-moving steam engine train. Some probate train rides are short, while other probates seem to never end. One of the critical stops in your probate journey will be to address federal estate tax issues. In part one of this topic, we began a discussion as to the reasons why a surviving spouse should file a federal estate tax return, including to claim the unused exemption from their deceased spouse, called the DSUE, and to establish the tax basis of assets being inherited by the surviving spouse and others for income tax purposes. In part two tonight, we continued this discussion by examining the calculation of the DSUE amount, learn about the concept of portability, and highlight important filing deadlines for the estate tax return. We will round out the part two discussion with a discussion of tax opportunities in filing an estate income tax return. We are pleased to have returning as our guests tonight the two estate tax attorneys who led the discussion in part one. They will serve as our guides as we continue our show in part two. Our first guest is an attorney and CPA with Creative Planning Legal PA in Kansas City, Missouri, where he concentrates his practice on taxation, estate planning, and tax-exempt entities. He prepares and files annually hundreds of federal estate tax returns and handles numerous federal audits of those returns. He received his law degree from the University of Kansas Law School and was recently recognized as a Missouri and Kansas Rising Star in the law. Our second guest is an attorney with Reese Broom PC in Tysons Corner, Virginia. He concentrates his practice on taxation and estate planning and administration. He received his law degree from the Catholic University of America and an LLM in taxation from Georgetown University Law Center. He is also a CPA and certified financial planner, and he continues to serve our country as a JAG attorney with the West Virginia Air National Guard in Charleston, West Virginia. Please welcome attorneys Matt Menser and John Morgan. Guys, thank you very much for coming back to talk about this topic. Matt, I'm going to come right to you, and let's just kind of review a couple of key things we talked about in part one. When must a 706 estate tax return be filed by somebody?
The return must be filed if the assets of the decedent exceed the applicable exemption amount. Currently in 2021, that exemption amount is $11.7 million.
Okay, so we absolutely must file a return if we have assets that exceed that. Now, what is the due date for filing that return?
The standard due date is going to be 9 months from the date of the decedent's death. We can ask and receive a 6-month automatic extension, which would put it at 15 months from the decedent's date of death, but you do have to apply for that extension.
And there is, I guess, a safe harbor that may apply in certain situations for folks that were forgetful or otherwise were dilettante, weren't diligent about getting that return filed. Is that right?
That is correct. There is a revenue procedure that was issued in 2017 where if we are applying solely for portability of the deceased spouse's unused exemption and we're below the threshold, then we have a 2-year safe harbor to file that portability election.
And that really leads me to my last question that we sort of regrouped from what we talked about in the first show, what are the reasons to file Form 706 even if you're not required to do so?
Yeah, even if we're below the $11.7 million applicable exemption in 2021, there are several instances where a executor or trustee will want to file a Form 706 for the estate tax return. A primary reason is to elect portability. What portability is, it's the ability to take any unused exclusion amount that was not reported on the deceased spouse's return and give that to the surviving spouse.
Okay. John, I'm going to come to you now, and let's talk about, we've talked about this, quote, DSUE amount or deceased spouse unused exemption. Explain to me what that term DSUE means.
That means is that each spouse in 2021 has an exemption amount of $11.7 million that spouse can pass to anyone they want, free of any estate tax. It may be the case that a married couple has, say, $10 million, but some amount less than that passes through the first spouse's estate. Whatever does not pass through the first spouse's estate might be able to be used by the surviving spouse.
And how is the DSUE amount relevant to the federal state taxation for the surviving spouse?
Sure, it's relevant because I think of it as providing an opportunity for simplifying estate plans. It used to be the case for many years, decades even, that estate plans were designed to provide certain trust in each spouse's case so that basically if you didn't use it, you lost it. Now, it's an opportunity for spouses to have simpler estate plans without sacrificing estate tax savings.
And let's just continue with that discussion. The other concept we want to talk about, John, is portability. Now, Matt mentioned this, but why don't you go over that again? When we say portability, that's probably the most important development in estate tax law that you started to allude to.
Yes, it is. So we got portability about a decade ago. And basically what that says is if we have a situation where, just using some simple numbers, the first spouse dies, giving $1.7 million to another child or some other third party. And that's the $1.7 million was all that was in that spouse's estate. The estate, the executor of that deceased spouse's estate, can file an estate tax return porting over the remaining $10 million over to the surviving spouse, functioning very much like a coupon of sorts.
That's awesome. Now, Matt, I mean, John was just talking about the relevance of the portability and so how do we go about, I just want to reiterate, how does a surviving spouse claim that DSUE amount so she can port it into or he can port it into their estate? How do they do that?
It's a two-part process. The first part is that we must file an estate tax return for the deceased spouse within the timelines that we previously discussed.
Okay.
And in that return, we will elect to say we had some unused exemption amount. I'm electing to port that over to me. The second part of that equation is when that surviving spouse dies, we have to report to the IRS how much that unused exemption was in order to take advantage of the coupon that John so adequately put it for.
Now, so let's just say we do that. We file a return. We claim the unused exemption, so we have this little coupon in our pocket to use. And now the spouse remarries. What happens in that process? Does any part of that coupon any part of that coupon be shared with the new spouse?
It can't be shared with the new spouse. So we can't stack multiple. If you get remarried 5, 6, 7 times, you only get one DSUE. But you may be able to use some of that DSUE while you are still living to make gifts. You can use gifts of the DSUE amount while you're still living, and you may be able to utilize it that way.
Okay, so there is some planning there, but if you do remarry, you want to make sure you take a look at that. Let's go to the next thing. John, let's talk about, we talked about federal estate tax, but I know we didn't want to overlook, and you mentioned that when we were preparing for the show, the importance of, do some states have an estate tax as well?
Yes, Rich. Some states do have their own state level estate tax. Not most at this point, but some do. Some pitfalls there are that just because you may be under the exemption for federal purposes, the state exemptions are very often lower than the federal exemption. For example, right now, the federal exemption is $11.7 million, and in DC, we have an exemption amount of only $4 million. Maryland, it's $5 million. Those states' rules also vary. Some of them provide for portability for a surviving spouse, and some do not. Also, in some states, it's required to, even if you're under the exemption level for the federal estate tax, some states will require you as the executor of an estate to produce a pro forma or an as-if federal estate tax return just so that they can match up the numbers appropriately.
Oh, interesting, interesting. Now, John, we also talked, I see that some states have something called an inheritance tax. Is that a tax on the decedent's estate?
No, an inheritance tax is really a tax on the receipt of an inheritance to the inheritors rather than a tax on the estate. Most states only have one or the other, an estate tax or an inheritance tax. At this point in time, I believe Maryland is the only state that has both tax regimes. It is typically for the inheritance tax based on where the decedent died, but it's levied against the people inheriting from the estate.
Okay. Well, let's turn, John, while I have you on tax, let's talk about the one return that we mentioned at the outset of part one, and we talked a little bit about, is this fiduciary income tax return. So we have a tax return as an individual, Form 1040, and that's reports your tax activity. But when someone dies, we have this other tax for the estate. So in the year of death, what is the tax period that is reported on the decedent's final 1040 tax return? Let's start there.
The reporting period for the decedent's final 1040 individual income tax return runs from January 1st in the year of death until that person's date of death that same year.
Okay. And so then when does the estate tax period begin to run? Is that when the date of death?
It starts running on the date of death, and it usually concludes December 31st of that same year, except in certain circumstances when a fiscal year is elected.
Okay. So Matt, let's turn to you. So we've talked about the final 1040 for the individual. The estate then has its own fiduciary tax period. Does the estate need to get its own tax ID number for purposes of reporting its income?
It will. If there's any income that the estate has earned after the death of the decedent, then the estate must get its own separate tax ID number in order to file that Form 1041.
And I know John kind of alluded to this, that the tax year for the estate could be from date of death to the end of the calendar year, or it could be some fiscal year that might run up to 12 months. Is that true?
That's correct. And the executor has the option. They can choose between a December 31st year end or the fiscal year end. And a great example of this is if you have a decedent that dies November 15th. Well, they're only going to have a month and a half if they elect a calendar year end. So there's going to be 2 returns that have to be filed, most likely, year of death and then the next year when the estate concludes. If you're able to get everything wrapped up within 365 days, then electing the fiscal year, which in my November 15th date of death example would run from November 15th to October 31st of next year, then you may be able to deduct all the income and expenses and report it all on one tax return.
Okay. So the tax year can vary from that. And the form that we file is Form 1041 for the fiduciary tax return?
That's correct. You'll hear estate taxes being thrown about, and you always have to clarify because there's the estate tax that reports the fair market value as of the date of death. And then there's the estate income tax, which is reported on the Form 1041.
That's absolutely right. Now, John, we're talking about the 1041 tax return. Can you explain why it might be advantageous not to claim expenses on the Form 706 that otherwise we could deduct, but instead claim those on Form 1041 for the estate? Why would we do that?
Sure. Today, typically a whole lot more estates are subject to the estate income tax return than they are to the estate tax return. That is, again, you have to reach that threshold of at least $11.7 million to be subject to the estate tax, whereas for the estate income tax, you hit the top income tax rate, which is 37%, after only about $13,000 of income. Because of that, it might be more advantageous to allocate those deductions on that estate income tax return to mitigate income taxes due to the estate.
Sure. And of course, if we're leaving all of our assets to a surviving spouse, we get a full marital deduction, so there's no point in wasting those expenses on a 706 return. We just load up the 1041 for all the attorney fees, CPA fees, and stuff like that. Is that something you would suggest?
Absolutely.
Okay. Now, and in the last year, is there any benefit that will flow through from any of those unused deductions that we could pass on to some of the beneficiaries? Is anybody familiar with that?
Yeah, in the final year of either an estate or trust, any unused deductions or other tax attributes of that estate or trust can be passed down to the beneficiaries. But you can only do that in the final year when that trust or estate terminates.
Right, that's the final year. So that's where you could pick up a lot of expenses that could be passed on. That's important. Now, John, I didn't mean to come away from you there. Now, many folks, John, use revocable trust to hold some or all of their assets. If the revocable trust becomes irrevocable on the death of the decedent, does the trust get its own tax ID number and file its own tax return?
Yes, if that is the case, that the trust does become irrevocable on the death of the decedent, then the successor trustee at that point in time should go to the IRS website and obtain a tax ID number for that trust.
And the the tax year for the trust reporting is going to be, is that a calendar year for trust purposes?
By default, yes, it is a calendar year, so January 1st until December 31st of a given year, but the trustee can pick a fiscal year as well. That is a tax period that ends on the last day of any month other than December.
Okay. Now, I know that a lot of people will try to combine as one return the trust and the estate. Can you explain that election? Is there some sort of an election that allows you to do that?
Yes, there's an election for doing so, and in many cases that does make sense for a very simple reason. It reduces your accounting fees or your compliance costs, just having to file one return instead of two.
Okay. Now, to follow up on what we're talking about, Matt, people who have attorney fees and CPA fees and fiduciary fees, because we might want to claim that deduction in the last year, should they hold off paying those until the final tax year?
Yeah, if their professionals will let them get away with that. Yeah, typically, and there may be some residual expenses that have to be paid because normally the estate tax return is one of the last things that gets prepared as a part of the closing of the estate.
Sure.
But yeah, I do believe that there's probably some prudence there in trying to pay those things towards the end in order to deduct them and possibly get some of those deductions down to the beneficiaries.
Matt, I'm going to continue with you. Who should prepare this 706 return? Should this be something that the regular executor, a layperson should take it upon themselves to prepare, or should they go get a CPA or an attorney to do that?
I would recommend, I'm biased obviously, but having a qualified professional that has filed these in the past, because there are a lot of pitfalls in these returns. Just going through the instructions themselves will take a layperson hours upon hours, and some of it may be applicable and other parts of the instructions may not be. So I would recommend absolutely having a CPA or attorney who is knowledgeable in these areas, at least be consulted before the return is filed.
Sure. Now I'm going to really ask, I know we talked about this during the preparation for the show, Matt and John, what can folks expect to pay to prepare a 706 when the sole purpose of filing it is to claim the deceased spouse unused exemption?
It's going to depend on what area of the country that you're in. I would say in the Midwest, it's fairly common for basic portability estate tax returns to cost anywhere between $3,000 to $5,000, depending on the nature of the assets.
Okay. And John, for the returns you're preparing over there at DeReese Broom, generally do you guys bill on a flat fee, or is that generally on an hourly basis that you see?
We typically bill on an hourly basis, but that being said, usually from the outset, after I gather some facts, I can give an estimate as to what I think the total would be.
Okay, sure. Matt, I want to go back to you. Can a fiduciary, how can the fiduciary know that the IRS has accepted the 706 that we file? How can we know that's been accepted?
Yeah, it's important for the fiduciary to know because there may be some personal liability that the fiduciary may have if they disperse the assets to the beneficiaries without the estate tax being taken care of. So the executor fiduciary has a few options. They can request what's called a closing letter to the IRS. And that closing letter is simply a letter from the IRS that says, we've looked at the return, looks good, no changes, you can close the estate out. You can also request a tax transcript. And on that tax transcript, there will be a code that indicates that the IRS is done with its review and examination of the return. And then finally, the executor can file what's called a Form 5495. And that alleviates any personal liability that the fiduciary may have on either the decedent's income tax returns or the estate tax return.
So how easy is it to get that closing letter? Because I've seen a lot of resistance to the IRS issuing those these days.
It was much easier, definitely pre-COVID, and even before then, it's gotten more difficult. The IRS has released guidance that if you receive a tax transcript, which anymore now you can receive online the same day, as long as that code indicating that the estate tax has been reviewed and closed, the fiduciary can rely on that in order to make final disbursements to the beneficiaries.
Okay, okay. All right, let's talk about some final thoughts from each of you guys. John, I'm going to come to you. We're really, coming to the end of 2 shows where we talked a lot about basically the importance of claiming this DSUE amount. A lot of different things we talked about that connect to that particular topic. I would like to get your final thoughts, your advice, any recommendations you have for our viewers.
Families should focus not only on the federal estate tax system, but also, depending on where they live, their state levels of estate tax, because if they're not paying attention to that, estates might be subject to quite a bit of money in terms of this state level estate taxes if they're not planning for that accordingly. And one other thought based on what Matt was just saying about the federal closing letters. I'm dealing with a situation right now where I've been waiting quite a few months for a federal closing letter from the IRS to close out an estate, where we're also dealing with a state level estate tax audit. We're kind of at a standstill right now because the state, even though I've provided them with transcripts from the federal audit, wants to see that closing letter, and I just can't produce it. So that can lead to some frustration sometimes in the administration of estates.
I understand that, and I know Matt mentioned about 5495 as a form you can use to get discharged, but it really is frustrating when you get that letter in the mail, and what they say is, if you don't hear from us in 6 months from the day you get this letter, then you're okay. So you've got 6 more months to wait before you're even clear. So
It's hard to wait.
so it's hurry up and wait. Matt, any final thoughts that you have, suggestions, words of advice, pitfalls to avoid for our viewers?
Yeah, I think my final word of advice is that the federal exemptions amount are always fluctuating. Currently it's $11.7 million, but that can be changed by Congress at any time, and it does change at the end of 2025. And so if you're considering making a DSUE, or gosh, my assets aren't large enough where that'll ever be a concern for me, just remember that those exemptions can change. And if you elect the portability exemption, you always will have that for the rest of your life, unless you get remarried. And so if you're considering, well, should I or should I not, I would try to persuade you to consider the future. We don't know what that exemption amount may be. Let's lock in the DSUE amount now, and that way we always know we'll have that regardless of what happens with Congress.
That is a tough conversation to have. You get a lot of resistance from especially elderly clients who don't want to spend the money to go ahead and file that return because they think I don't have enough assets. But unfortunately, the world continues to change, and especially tax laws are no different than anything else. Well, I want to thank both of you guys on behalf of the Probate Nation. Matt Menser from Creative Planning in Kansas City and John Morgan from Reese Broom and Tyson's Corner for sharing with our viewers your knowledge again, advice, experiences on federal estate taxes generally, and specifically on how a surviving spouse can claim the DSUE. Your comments this evening provide valuable information and are a great public service to the Probate Nation community. So guys, thank you very much again for taking the time.
It's been
Thank
fun.
you for having us.
Without a doubt, federal estate taxation is complicated and very technical. But as we learned over the course of 2 shows, there are a host of tax steps that should be considered and acted upon even if there is no federal estate tax due. Claiming the DSUE amount for a surviving spouse by filing a federal estate tax return is probably the most significant step. And failure to file that 706 return can result in the inheritance passed on to the children being unnecessarily reduced when the surviving spouse dies. This is a complicated area of the law, and what you learn from our guests is only an overview of key tax issues. When a loved one passes away, the clock starts to tick to claim the DSUE amount and other tax benefits. So it is critical that you act as soon as possible to reach out to a tax attorney or CPA who is experienced in estate tax matters for their guidance. This brings us to the conclusion of our show this evening. Hope you enjoyed it. And remember that replays of the show and other shows today can be viewed on the Probate Nation website.